monthly macro webinar here for February 2025. What we know so far. It's been, I titled the webinar What We Know So Far because it's been 3 weeks, give or take, since the new administration has come into power. And there certainly was a great deal of uncertainty about what campaign rhetoric would translate into actual policy on the ground. And while there's still a fair amount of uncertainty, and we'll talk a little bit about that through the course of this presentation, we're starting to see the shape of the reality, some of which is probably getting more rhetorical attention than the reality of its impact, and probably a fair amount of other policies that may not be getting the attention that they deserve given their overall macroeconomic impacts. And so here, while typically I'll talk sort of globally about what's going on in the world in terms of key dynamics, here I'm really focused on what's going on in U.S. markets and U.S. policy, particularly federal government policy that we're seeing right now. But before we get into that, it's just very important to set the stage for where we stand in terms of expectations and asset pricing. A lot of folks had came in, viewed this administration as the most pro-business administration that it was going to be in power since in the post-war period. And as a result, expectations of future growth because of that view and other views related to the economy were very strong entering the year. And those of you who watched the January webinar will remember this chart on the left-hand side. Got a lot of attention subsequently, which is just relatively simple. It's a relatively simple chart, which is looking at what was expected in terms of growth for the U.S. economy coming in to 2023, 2024, and this year, and what ultimately transpired. And what you see is that there were very low expectations for growth in the U.S. to start 23 and 24, and the U.S. economy strongly outperformed. From a macro perspective, that's a big reason why stocks did so well in those 2 years. And when we enter 2025, expectations for growth have been much stronger, between 2 and 2.5% coming into the year. And I think that's important to recognize because the base and that baseline expectation is already in the price of stocks that you see today. So much higher expectations of growth, in part driven by what is expected to be a very pro-growth set of policies from this new administration. That's not just an economist estimate of strong growth, but also earnings expectations that are priced into the S&P 500 are also very strong. On the right-hand side, we see an updated chart of what's expected in terms of S&P 500 earnings growth over the course of the last couple of years and into 2025. And there you see expectations of growth nearly 17% by year over year by the end of the year. And so what you see is very, very high expectations when you're looking at growth or you're looking at what's going on with earnings expectations. And it's not just earnings expectations or economist views, it's also what's priced into PEs, which gives some indication of not just strong growth in the short term over the course of 2025, but very high long-term growth expectations that exist with PEs reaching near all-time highs. Really, the last time that we saw PEs at this level in a late cycle environment, very different than an early cycle environment, in this late cycle environment was the late 90s bubble. So let's turn to the policy dynamics that are currently in place here that will set the stage for the U.S. economy over the course of the next couple of years, the next 6 to 12 months, and then over the next couple of years. The first thing I'd emphasize is that there is still extraordinary uncertainty in terms of what policy mix we will see. The common refrain is that campaign rhetoric is not policy, and desired policy is not implemented policy. Those are two important steps that have to occur in order for policy in order to understand what policy is actually going to be implemented. And so what we see here is a lot of uncertainty about what that actually will be. These are various measures drawn from a variety of different sources, trying to systematically understand how much uncertainty there is, say, reported in the media, et cetera, about what policies will transpire. And whether you're talking about trade policy or you're talking about economic policy more generally, both in the US and essentially on a global scale, we essentially are facing the greatest uncertainty that we've had when it comes to the policy mix ahead in several decades. And so, what we're trying to do here today is to start to take a look at the different policies that are at play and try and get our arms around what is likely, what information are we getting to start and what can we infer from that. And I like to kind of think about this, the possible implemented policies across two different lenses. One is what is the likely macroeconomic impact of a particular set of policies, and that's what you see higher or lower there. And then the second is left to right, I should say. And the second is trying to get your head around what is the likely, how much confidence can we have in that understanding as of today. Now, this is just essentially me trying to get my head around it, but I think it's helpful in trying to sort of focus where we should be looking at and what is likely to be most macroeconomically impactful. And when I look at that basic picture, the biggest story that will impact the US economy most likely over the next 6 or 12 months is the immigration policy story. It's one where we have almost certain clarity, certainly on inbound immigration, which has fallen to close to zero, and I'll show that a little bit later. A little more ambiguity on how much repatriations will occur, but still the direction is pretty clear in terms of immigration policy, and one that is wildly impactful uh, in terms of setting the baseline growth for the U.S. economy. We had strong growth over the last couple of years with labor force growth of 1.5 to 2%. Cutting labor force, and the vast majority of that was from foreign-born, an increase in foreign-born labor. Changing that to essentially zero or possibly negative would radically change the potential growth rate of the US economy. So that's really in the upper right corner, the thing that looks most impactful and frankly kind of taken for granted as being taken as a given. And the macroeconomic consequence really not getting as much attention as I would have expected. And all the way on the right hand side, on the lower right hand side, you have something like Doge, where there's a fair amount of uncertainty about what's actually going to occur, but just the orders of magnitude that appear to be executed, at least so far, don't look particularly impactful. So something that's getting a lot of rhetoric and attention, particularly amongst the political sphere, but isn't necessarily actually economically meaningful in terms of the size of its implementation. And so we'll go through each one of these different pieces, but it's always important. It's very important to both have an appreciation of what your certainty is about anything of these policies, but also what is a big deal and a small deal macroeconomically. And that doesn't mean that's not to discount whether people think certain policies are a big deal or a small deal. I'd call it from a political standpoint. In this conversation, I'm not focused on the political implications of certain policies being implemented or executed. I'm solely focused on what is uh, the macroeconomic, whether it's growth or inflation policy impact. So let's get into this labor story. The vast majority of U.S. economic growth, uh, particularly in terms of the labor markets over the last couple of years, really since early 2022, was driven by an increase in foreign-born workers being employed in the U.S. economy. That's what you see on the left-hand side of the chart there, with native-born workers basically flat in terms of their job growth, and foreign-born workers rising relatively significantly over from the 2022 period. Also, what I'd emphasize is that nearly all the loosening of the labor markets that we've seen so far has come from an increase in unemployment of foreign-born workers. That's what you see over there on the right-hand side, where you see, over the course of the last 2 years, foreign-born worker unemployment rate has risen, somewhat substantially, about a point or so, whereas native-born worker unemployment remains at about 3.7%, and right at basically the average level of the last couple of years. And so what that emphasizes is that nearly all the job growth that we're seeing in the labor market is really a function of the substantial amount of immigration that we saw in 22 and 23. And similarly, nearly all of the loosening of labor markets, in many ways, what has been described by the Fed as a desirable loosening of labor markets, has come from an influx of foreign-born labor. I can show charts also of for instance, by education, nearly all of the loosening has occurred in the high school education or below cohort as well, all indicating essentially unskilled or lower skilled foreign-born workers being an important component of loosening labor markets. Now, that's important because basically what this has done over the course of the last couple of years has created a large disinflationary pro-growth impulse on the U.S. economy. And if we go back to our chart here on the left-hand side, it has been this influx of foreign labor has been a critical component of achieving the type of growth outperformance relative to expectations that we've seen in the last couple of years. Now, as we know, that policy is changing, and it was already starting to change a little bit in the later months of the previous administration. On the left-hand side, what you see is border encounters by month. This is something that the U.S. Border Patrol tracks and reports on a pretty timely basis. We have data through December, and we'll get January data pretty soon. And what you can see there is that in 2022, we started to see a pickup in the number of encounters on an ongoing basis, and it was elevated in 2023 and through much of the first half of 2024. Again, all of things that increased the supply of labor foreign-born labor that we just talked about, but really starting in the summer through a number of executive actions, that flow of labor has started to slow, about halved in the later months of the previous administration. But what I'd emphasize is that indications are that the amount of border encounters, even though we don't have the full comprehensive data, anecdotal evidence suggests that essentially inbound foreign-born workers has fallen to essentially zero in the new administration. You see a quote there from a group from a media source that followed the Customs and Border Patrol agents in the Tucson sector, which is a very common area in terms of where border encounters occur. And they claim that border encounters fell by about 90% since the new administration came in. There are some actual policies that were also implemented that were consistent with further restricting the amount of inflow of foreign-born labor. And on the right-hand side, there's also been an indication of an increase in in arrests and which are typically the leading edge of repatriations. Repatriations in the last couple of years have been pretty modest. Most of the big spike in repatriations were related to Title 42, which was basically a COVID era measure that caused immediate repatriation of folks who came into the country. If you just look at sort of enforcement actions and removals, what you see is that the number has actually been pretty low. Well, in the first couple of weeks of this new administration, we've seen an increase in the pace of arrests, about a tripling of the increase in the pace of arrests as reported by ICE, the Immigration and Customs Enforcement Agency, which is the predominant law enforcement agency that identifies unauthorized folks in the U.S. and arrests them and repatriates them. And so we've seen kind of a 3x increase in that, whereas those sorts of removals were running at a pretty low rate in previous years. We're probably seeing a tripling, something like 500,000 or 600,000, up from about 150,000 in the last couple of years in the late previous administration. And so that you're talking about a few 100,000 more at least so far, an indication of a few 100,000 more repatriations per year than what we saw previously. You add that together, you basically have a constraint. The inbound labor supply constraint is actually the big thing, right? Falling from something that was running at almost 3 million people a year. Again, 3 million people who were identified. Probably the actual number was higher than that. So that labor supply is probably contracting by about 3 million on an inbound basis on an annual basis. And we're probably seeing a pickup in repatriations of, let's say, 500,000 to be, to use a round number. So you're looking at, 2.5, 3.5 million in terms of the shift in the net migration of foreign born labor. And just for context, if you just take a look at this left hand chart, what you saw was during this period where we saw about 6 or 7 million reported increase in foreign-born workers, increase, I should say, in border encounters. You saw, a pretty substantial share of those folks, 4-ish million increase in the number of foreign-born workers. And so what you see there is that it doesn't, the flow through from immigration to employment, while it's not instantaneous and it's not 100%, a fair amount of those border encounters are then creating, are then folks who ultimately are becoming employed in the United States. And this is really important as this shifts because it totally changes the underlying labor dynamics in the US economy. Not only if we see basically if we see an elimination of essentially all immigration, the baseline number for US employment, say on a monthly basis on payroll, to maintain the existing unemployment rate or maintain, full employment falls probably as low as 50K, maybe even lower than that, depending on how you think about the demographics. That's a pretty significant decline relative to what we saw in the last couple of years, where it took, roughly 200,000 to 250,000 a month to keep labor markets stable. And frankly, when it comes to the potential growth of an economy, it's pretty simple, which is, labor force growth times productivity growth equals real GDP. Like that's basically how it works. And so to the extent that you significantly constrain the amount of incremental labor into an economy, that significantly reduce, that's basically 1-for-1 reduction in terms of likely growth rates. So that's either got to be made up with much higher productivity growth, which we're not seeing indications of, or the US economy will likely slow given the more limited supply of labor. From a inflation perspective, it also increases the probability that we'll continue to see upward pressure on wages, particularly in those lower educated cohorts, which have been the primary or the highest, where we've seen the highest growth rate in income growth, in nominal income growth, and where there's a very high propensity to spend. And so in the same way, if we go back here, the flow of labor supply was an important disinflationary pro-growth impulse in the US economy that we saw over the course of a couple of years. The reversal of that is most likely an inflationary negative growth impulse in the US economy, again, right as growth expectations are relatively elevated compared to the last couple of years. Now, I linger on the labor supply dynamic because it is the most important, the most macroeconomically impactful dynamic that's going on. And so that's why it deserves more attention than probably several of the other areas. Let's turn our attention to tariffs, which obviously there's still a great deal of ambiguity about tariffs. When you think about tariffs, there's basically two different sides of the macroeconomic impact of tariffs. One, tariffs are essentially an increase in the cost of a good, which will likely, which can increase inflation. And it also can reduce real spending because to the extent that goods that are not substituted for have higher prices, typically consumption would decline. On the flip side, and in many cases, the more impactful side, what you see is that retaliatory tariffs actually cause foreign demand to slow, and that means that U.S. exporters take a hit in terms of their production or sales abroad. And so what you're seeing is basically both sides of the equation here in terms of what could be the impact. So on the left-hand side, what I've penciled out is what the likely impact is from the 25, 25, 10 tariffs, which we saw, were proposed in the beginning of February. They were temporarily paused, at least for the Canada and Mexico ones, for at least 30 days, whereas the Chinese ones were allowed to flow through. And what you see here in terms of an increased cost perspective is, it totals about 0.5% of GDP. Is that a big enough deal to radically change US economic conditions? No. Is it a big enough deal to totally change the inflation picture? No, but on the margin, it is a negative growth, positive inflation impulse that will hit the economy were these tariffs to actually flow through. Now, if you look at the flip side, actually, one of the more impactful stories is the flip side story of the retaliatory tariffs that the US might face. In this case, on the top line, what I show is what the prospective economic impact would be from the initial Canadian response. Of course, they paused that as a result of the US tariffs being delayed, but it gives you a sense as to the magnitude of impact that could occur were those retaliatory tariffs to flow through. That's what we see there with the 75 across a number of different industries. And then the equivalent, let's say the equivalent that would exist if Mexico implemented a Canada style retaliation, that's the 83. And then the Chinese retaliatory tariffs to the incremental 10%, which so far have been pretty modest, but could easily increase. If you take each one of those different pieces, what you see is that it would probably add up to about 0.5% of GDP hit to the US export sector. And so you put this together, and this sort of 25, 25, 10 tariff implementation and the retaliation that would likely come with it would add up to about 100 basis point drag to US real economic conditions. Is that I should say in the course of a 6 to 12 month time frame. Not in and of itself enough to totally derail the economy, but enough to create a drag, particularly in an environment where you have elevated expectations. In addition, you'd probably see an increase in inflationary pressures coming from this. On the right-hand side, what you see is the some estimates of what the possible impact would be on U.S. prices as a function of these incremental these incremental tariffs. These are modest in terms of their impact, but certainly in an environment where the Fed is looking for lower inflation in order to deliver easier monetary policy, it would likely be incrementally, undesirable. And you could see, we could quibble about the sensitivities and the substitution and all that stuff, but this gives you a sense of the order of magnitude. It's about, 0.5-ish% impact. Probably what's a bigger deal when it comes to these things is the risk of a capital war. And when I say a capital war, what I mean is that foreign investors in U.S. securities that are adversarial to U.S. interests sell their securities, which creates second and third order effects on, which drives down the price of U.S. securities and increases, in particular, interest rates, which can have a significant macroeconomic effect. It can also, both in terms of activity, borrowing and lending activity in the economy, but also on things like U.S. stocks directly. It is notable on the left hand that we saw a increase in the sales of U.S. bonds as measured by holdings at custody at the Fed, which is where most foreign central banks hold. The vast majority of U.S. Treasury bonds are held in custody at the Fed by foreign central banks, and we saw a relatively acute drop in those holdings at the pace of something like 100 billion a year annualized pace over the couple of weeks post-election. To give some context, the total duration issuance, bond issuance by the U.S. government in the previous fiscal year was about $1 trillion. So this would be equivalent to the total long duration financing activity of the U.S. government. Of course, it happened in a 1 month time frame, but it gives you kind of a sense of the order of magnitude. These are big flows. They could be a big deal in terms of making an impact on the U.S. Treasury market. And notably, too, what we saw was the dollar. Of course, a lot of foreign central banks will sell US dollars and buy their own currency in order to support their currencies. This dynamic happened actually. The pressure on foreign currencies was about the same before the election as it was after the election because the election outcome started to get priced in. And so it's notable that before the election, weren't a lot of bond sales. And after the election, there were a lot of bond sales. I'm not saying, I by no means any certainty about this, but when you look at how the timing of this lines up, it certainly raises questions about whether this was a bit of a test that foreign central banks used in order to, post-election to kind of get a feel as to what their plausible impact would be. And what you saw was, U.S. interest rates rose by nearly 50 basis points just simply from this $100 billion of sales post-election. That's a pretty substantial increase, and it started to take the air out of stocks as a function of that. And so, you look at that and you say to yourself, you really could have a meaningful impact were there to be more of a capital war that occurs. And of course, many people will say, well, look, if you have a capital war and you sell the securities, it will drive the price of the securities down. And that's not an economically advantageous decision by these foreign central banks who are big holders. What I'd emphasize is foreign central banks do not engage in economically beneficial activities just through the sheer nature of accumulating reserves, which is essentially selling and appreciating currency and buying and depreciating currency. They are by definition non-economic players. They are loss-making entities in the markets. And so and the reason why they do that is because they're driven by other forces than solely making money on their own securities holdings. And so you could easily see a circumstance here where they would be comfortable taking losses on their overall portfolio in order to make an impact, let's say, on global cross-border capital markets and the U.S. markets in particular. So that's really the thing that I'm looking for, much more so than the trade element, although the trade element does matter. Let's turn our attention to other financing activities, particularly the government financing activities. A lot of attention has been paid over the course of the last year or two to the debt profile of the U.S. government having meaningfully increased the amount of treasury bills in terms of its overall share of financing. And new administration officials have made it clear that they intend to extend the debt profile of the United States. As it is, the U.S. debt profile is actually the shortest of any major developed economy. And so it is quite short in duration, and the share of bills is elevated compared to where the rough target is, which is intended to be around 20%. So far, we haven't gotten a lot of indications that that was going to change. The first QRA announcement, which happened a few weeks ago, indicated essentially no change in the projected financing activity or the share of bills versus bonds. That's not so surprising given that at the time in which the QRA was announced, Bessent had been seated and confirmed for only a few days. And so many of the officials that would typically be involved with this decision-making process weren't necessarily in the building. But it is a notable, it was a possible opportunity to extend the debt profile that was not taken at that moment. So far, it basically looks like, more of the same, at least for the next 6 months or so. What was also notable in the context of that financing announcement was essentially no change in the expected deficit. Now, there's been a lot of talk about how deficit reductions are likely to occur, whether it's through the DOGE process or through legislation. But so far, the Treasury is not projecting any meaningful change in the quantity or the amount or the magnitude of the deficit. And so that's an important, it's an incremental piece of information, which suggests that at least so far, the desire to reduce the deficit might be more campaign rhetoric or more political rhetoric than it is actual reality when you're looking at the cash flows. That actually connects nicely to the conversation about the DOGE story. I think if you watch or read the sort of mainstream press, mainstream political press, the DOGE process has gotten a lot of attention. What I'd emphasize is that there's a lot of ambiguity. That's the first thing I'd emphasize. A lot of ambiguity about exactly what is likely to transpire here in terms of the magnitude of the efforts, let alone all of the prospective legal challenges and things like that, which, I have no basis to opine on. As a macro investor, I'm focused on the cash flows, and what I want to see is, are the cash flows changing or are they not changing? Because if they're changing, that has an impact on incomes and as a result on spending. And so far, what you see on the left-hand side is that there has been no change in the cash flows of the US federal government, particularly on the outlay side, as a function of whatever the heck is going on in the Doge process. You see that on the left-hand side. That's the accumulated withdrawals. Withdrawals mean payments out of the Treasury from the Treasury daily statements. There's obviously a lot of seasonality and different dynamics that go on there, so you don't necessarily want to get too focused on any particular days. But what you see basically on the left-hand side is that through the first 13 business days, there's really been nothing in the way of a meaningful uh, a change relative to the previous year in 2024, the matching days in the previous year. So keep an eye on the actual cash flows. A lot of talk about things, but the actual cash flows here don't seem to be changing. And so, there's a real question: is this actually a meaningfully macroeconomically impactful story that's going on here? There's also been a lot of talk about things like the buyout of the employee buyout, which the latest indications, it's actually quite, there's not a lot of transparency in this. So there's some news stories that say something like 50,000 government employees took it. If you just take into consideration their 2.5 million government employees, give or take, 50,000 is pretty tiny in the scheme of the overall federal government. If you think like the typical quit rate in the U.S. and the overall U.S. economy is about 2% a month in terms of employees. What you see here is like 50,000 employees on a $2.5 million or 2.5 million person employment is just not that big a deal. In fact, that's probably what you'd expect to be the normal attrition that would be occurring, or the normal turnover in terms of quits in the government. So, so far, not a lot of indications of anything that's going on there. Probably the only place that looks like there's been a meaningful shift, at least so far, is that payments through USAID, which is a couple tens of billions in terms of overall outlays per year, has fallen to zero. But we're talking about pretty modest stuff here in terms of the executive efforts to constrain spending, despite a lot of the campaign rhetoric. We'll keep an eye on it. Maybe it'll change. Maybe there'll be something more impactful. But when I look at these numbers so far, I'd say not much here, not much to really focus your attention on. What really matters is congressional and legislative action in terms of what is likely to happen with spending. And in particular, the U.S. government is facing a significant change in tax policy that will occur, a significant increase in tax policy that will occur if it's not extended, if the TCJA is not extended. And so that's probably one of the biggest stories, the most macroeconomically impactful stories that you'll see over the course of the next 6 months. Those tax cuts, I think it's really important to recognize that those tax cuts are current law. They reflect the current tax rate in the U.S. economy. What that means is that the extension of those tax cuts, were they to be extended as is, would have no economic impact, no growth impact from the simple extension of them. Why? Because they're already part of the growth rate the underlying growth rate that we're seeing today. What would create an economic impact would be either further tax relief that occurs. So the types of tax relief that was discussed in the campaign that's shown here on the right-hand side, things like overtime exemptions, no tax for tips, reduced tax rate on domestic manufacturing, or other small business tax breaks. Those would have to occur in order to get a positive growth impact. Remember, the simple extension of the TCJA does not have a growth impact. It is already in the growth rates that we're seeing today. Similarly, essentially on the flip side, to the extent that in order to pass the TCJA as it is, there have to be offsetting cuts that occur. That is directly economically detrimental because those tax cuts are not in current policy. So they're incrementally negative in terms of spending rates. And that's what you see over here on the left hand chart. If you're going to talk about something that's going to be revenue neutral or deficit neutral, you're going to need something like $5 trillion of $5 trillion of spending cuts that would have to align with the TCJA extension in order to maintain the deficit at the current level. That 5 trillion in spending cuts is over a 10-year time frame, which is the CBO normal time frame in terms of penciling things out. So about a $500 billion a year a cut to spending that would have to occur. That's a $500 billion cut per year is about a quarter of the existing deficit. That would be a meaningful cut in spending that would have to occur. And so the real question is, are we going to see the tax cuts extended and see a wider deficit, meaningfully wider deficit, or are we going to see those spending cuts, which will flow through to incomes and create a drag on economic conditions ahead? If you just take a step back before I get to one last point, then I'll start going through the questions. So we just take a step back. Essentially, all of the policies that we have seen so far are growth negative policies. Whether it's the restriction of labor, and I should say growth negative policies in the short term, in a time frame that a macroeconomic investor might be thinking about. If you look at the restriction of immigration, it is growth negative on a 6 to 12 month time frame. If you look at an increase in tariffs, it's clearly a growth, and the retaliation that will likely come, that is a growth negative on a 6 to 12 month time frame. And if you look at essentially any efforts to curtail spending, which to be clear is still a bit ambiguous exactly what's likely to happen, but if you start to see cuts that are necessary in order to get the current TCJA extended, that is also likely a growth negative story. And so you add these things up, and it's not clear, there's a lot of expectations, a lot of hope that this new administration would usher in a new era of strong growth. And at least so far, the policy moves that have been implemented and that look to have economic impact over the next 6 to 12 months are basically all in the direction of weaker economic conditions and on the margin, higher inflationary pressures. And so when you connect it back to what's going on with, comparing essentially what's priced in, those very euphoric expectations relative to the policy that's been delivered, it certainly looks like there's a gap between those two. And I say this not because, sitting in my seat, this is not to opine about whether the policies that are being implemented are quote unquote good or bad. It doesn't matter whether they're good or bad, or whether I have any particular opinion about that. There's simply policy and macroeconomic consequences, and the comparison of that policy and those macroeconomic consequences to what's priced in. That's what you have to understand as a macroeconomic investor, and you have to be agnostic to whether or not you think that it's sort of good policy or bad policy. They're just simply trade-offs and consequences. The last thing I'd end with, which is really sort of opens the door for on a longer term time frame, is that there's still, there basically has been no discussion of reduction in the regulatory burden in the country. This was an area that got a lot of attention in the campaign rhetoric, but so far at least has not been a real focus in terms of incremental policy behavior. And in total, that amounts to about $3 trillion, about a $3 trillion regulatory drag on the U.S. economy in today's dollar terms as a function of the accumulated policies over the course of the last 20 years. That's a massive drag on $27 trillion economy. That's not to say all of those regulatory efforts are, would likely be rolled back. There's certainly many of them that are, where the economic consideration is not the sole consideration that you want to be having, um, that the government would have about these policies. But it is a significant source of essentially economic drag and productivity drag that the new administration has focused on in terms of their campaign rhetoric. But so far, we have not seen much progress along this axis. This would be one of the few axes that would be significant in terms of being both pro-growth by reducing those regulatory burdens and likely disinflationary by reducing the cost of production, since a regulation is essentially just an added cost for the production of any good or service. And so this is really the question. I think the challenge here from the perspective of from an investor's perspective is it doesn't really matter. These sorts of things take so much time to work through. First, you got to get people installed, then you got to change the regulation, then it's got to have an economic effect. That if this is going to come, it's going to come over the course, well beyond the next 6 to 12 months. And so it remains to be seen whether that'll happen, but that is one of the few areas where there could be a significant pro-growth disinflationary policy mix, which at least so far has yet to be implemented.